All right. Hi. So today it's Richard Answer here. Well, I say unfortunately, Sonia's living life on annual leave, so I'm by my lonesome today. But the show must go on, as they say. Today's episode 10, season one. So it's at the end of season one. I want to talk about a really important topic: inheritance tax, and just the basics and fundamentals. I think everyone should have an understanding of this, especially if you're concerned about inheritance tax or want to protect your family wealth or have an intention to distribute wealth to your family and loved ones. It's really important to understand how inheritance tax works. What is it, and why should we be concerned about it? So let's get into it. Really, now inheritance tax really, by definition, is a tax on the transfer of wealth. And typically, wealth is transferred when someone passes away. Not always. There's other scenarios, but in the main, it's when someone passes away, wealth is transferred because obviously you're going to be gifting assets, whether by design, with a will, or by accident with a government will. Whatever you own, whatever assets you have in your name when a death event takes place, will be transferred to someone. If there's no family members at all, it will go to the crown eventually. So it's transferred, okay. And if it's over a certain amount, then that amount will be eligible. Is that the right word to use, or exposed to a type of taxation? So let me explain that in more detail. So everyone has a minimum allowance, okay. Over the age of 18, you're given an allowance. That amount, as of today, at the time of this particular live session, is £325,000. Now that hasn't changed, I think, since 2009. And inflation has gone up, and house prices, especially south of England, and Wales, it's at least a major problem, because house prices are very significant. It's very rare to find a house in England, south of England, for 300, below 325. Anything of decent uh, anything of a decent standard. So if someone passed away yesterday, so we talk of just Joe Bloggs passed away yesterday, and his wealth was below the threshold of £325,000, then Joe Bloggs would not suffer any inheritance tax challenge, because his wealth is below the threshold. And that threshold, we call it a nil rate, okay, a nil rate band. So there's zero tax to pay in that scenario. Now, it's not hard for any individual, over a period of time, to accumulate wealth. You buy your first home, you get a life insurance policy, you get family income benefit, you start to accumulate savings, investments. You may start a business, you may be a shareholder in a business, you may be a major shareholder if in a stock market. You may inherit wealth from family and loved ones. So those are the five main areas where you could be attacked, or need to be very mindful of inheritance tax. So just repeat that: being a property owner, being a business owner, having substantial savings and investments, and not to my pensions, at least not directly, um, and receiving a large inheritance from family and loved ones, and life insurance. So those are the five. Death in service. So life insurance, death in service policies, in my opinion, are the five major target areas for people to really consider. Um, the value of your estate. They're big contributors, big assets that contribute to your estate value. So you can easily be in excess of £325,000. It's not that hard, especially if you live in the south of England. Okay, so that's the first part. So this nil rate band 325 is pretty straightforward. It's done. It's calculated by default. And really, if you're listening to this and you know your wealth exceeds that, you just sat down and done some sums in your head. Um, Deduct any kind of debts, so any mortgages, can deduct it from that figure, and whatever you're left with is your estate value. And I'll come back to mortgages and debts, hopefully by the end of this, um, this discussion, or or I guess soliloquy in my instance and by myself this week. So that's the first part. Now the second part is in 2017 or thereabouts, there was an additional introduction to increase the allowances for inheritance tax. It was more targeted to families. It's a bit more complicated, probably a lot more complicated, but I'll keep it as simple as I can. So this additional layer of inheritance allowance is called a residence allowance or residence nil rate band, whichever you prefer. Now, why I say it's more complicated because there's just more rules attached to it. Now, as of today, the maximum amount claimed that can be claimed or utilised is £175,000, and that's for an individual. Now, the criteria for the individual is that you own a home and that you've occupied that home at some point through your property ownership. The length of time hasn't really been stipulated, but as long as it can be proven that you've occupied it at some period of time, uh, then you qualify. The property price has to exceed £175,000. So if you own a home that's worth £100,000, the maximum that you can claim as an individual will be £100,000. If you own a home that's £300,000, the maximum you can claim is £175,000. So I hope that makes sense. Now, the other criteria is that you have children. Now, that's a very loose term, children. So let's define what children mean. Uh, if you're single, then it's your biological children. It would be foster children. It would be adopted children, grandchildren, pretty much. Yeah. If you're married, you can include stepchildren is in that as well. Okay. So it will that's a quite a wide and step grandchildren. So it's quite a wide um definition of what a child means. And that can open a lot of doors as well. Now, having said that, so the maximum that someone, an individual person, can claim as for an allowance would be £500,000. Okay, that's 325,000 plus the 175,000, which the maximum can claim. That's £500,000. The other part of the residence nil rate ban that you've got to be concerned about and why it's so important to plan is you got a 2-year window from the date of death to claim this amount. Unlike the nil rate ban, the 325, that's just available. But you could lose out on the additional 175,000 once 2 years has passed from a death event taking place. So it's really important to get your affairs in order, get your ducks in a row. And that's why a document like the will is so important to have and to be drafted in the right way. There's no stipulations to how soon probate should be done. There's no law saying that probate must be done immediately upon the death. So if your executors are not moving forward or the will can't be found, there's nothing that's planned for, it can start to cause problems, and then that's more money going to pay towards inheritance tax than necessary if you're claiming it too late, in one way, shape, or form. So that's the kind of the fundamentals that you need to be aware of, and you can start to get a bit, I would say clever. I've had scenarios with clients where, for example, someone's single, but they fostered a lot and they've got very close with their foster children, or one particular foster child. And I've got one client in particular who got a very large amount of savings pot, very large property portfolio. So they're looking about maybe £2 million in total wealth, but they're single, in their 60s, but they have a foster child. So they've got options now because they could claim the residence allowance, because they can prove a foster child, they've occupied a home that they live in. So they've got a £500,000 allowance. They can start making gifting plans during their lifetime. I'm not going to go into too much now because of those options, gifting property during their lifetime to start reducing. I'm not going into too much detail about how to reduce inheritance tax. Today is just purely about what it is. But it just opened the doorway that maybe wasn't available before, or maybe weren't recognized before, if the advisor's not aware of the full criteria, what the definition of children means. Something else that is really important, if I could move on to married couples, especially blended families. Um, there was a lot of tax planning opportunities for married couples. And when I talk about blended families, it's important. All families are important, but blended families is a lot can go wrong if the planning is not done correctly. Um, but in general, for married couples, you can turn that £500,000 with the right type of planning into £1 million allowance, and also delay when inheritance tax can be paid because it'll be calculated on the second death of the surviving spouse, rather than the death of the first spouse immediately. The other thing that can be really crucial with planning for inheritance tax for couples, um, is couples can transfer their allowances that have not been used or utilized. So they can transfer their residence nil rate band to their surviving spouse if they choose to. Obviously, with the right planning, they can transfer their nil rate band of £325,000 allowance to their spouse. So that will then combine to give £1 million to the surviving spouse, which will make all the difference, especially if their wealth is on the cusp of £1 million. They could save from paying any inheritance tax at all. Whereas if they didn't do any planning, um, sometimes retrospectively it's difficult to do that. So if they didn't do any planning, it'd be taxed on £500,000 on the first death, and then questions could start to arise, and issues and challenges could start to arise because payments due like literally 6 months after the death event takes place. So this is where having the right knowledge is crucial. Speaking to the right individuals or people in the industry is crucial, so you can make an informed decision based on the correct advice going forward. So the other thing about couples is widows and widowers. Um, you can still transfer or claim the allowance of a deceased because you're still deemed as married, even though your spouse is no longer alive. Only once. So if you get married twice, you can claim it once, but it can be transferred, it can be claimed, and that's a really powerful thing. So even if you're deemed a widow or widower, and your spouse died years and years ago, then it can still be claimed. Both the residence allowance and the nil rate ban and the residence allowance can both be claimed, um, up to 100% of the deceased's allowance. Okay, so very important that we understand what's available there as well. So again, planning can be utilized in the right way in order to maximize efficiency for planning for inheritance tax purposes. So again, what I'm saying here is not advice. Okay, it's just guidance and education, as I call it. Um, well, I forgot the term now, but it's education and information combined. It's not for you to go away and say, right, this is specific advice. It's just guidance for you to open your eyes, do more research, get specific advice that is insured, etc. This is just purely general knowledge for everyone who's interested. But ultimately, you should be really mindful of what can be done, what's available to you. If you listen to this and you know that, or you know someone in that situation, maybe they've not received that advice before, so it's so important to understand. Um, One other thing that I want to talk about here, which is again we talked about the transferable allowances for couples who are married, or deceased, so they're widow or widower. Um, there is a cutoff point for residence allowance. Okay, so if your estate exceeds £2 million, the challenge that we have, and we speak to a lot of wealthy families, is that for every pound that your estate exceeds 2 million, then the allowance is reduced by £2. So effectively, once you reach 2.35 million, then you've basically lost your allowances for both couples, both individuals. That's £350,000. So the maximum allowances that you have now as an individual or as a couple, sorry, um, if you have an estate over 2 million, which again is not hard, um, it is reduced significantly. So you've got to get planning in place sooner rather than later to try and maximize your allowances as much as possible. Hence why we really start to educate clients and potential clients and future clients why it's important to get the right advice, especially in inheritance tax planning, so you can do the right things, make decisions in advance. As I said, to be forewarned is to be forearmed is to be forewarned. And that's something that's really, really, really important to get advice on and get information around. So that's why I said that the residence allowance is quite complicated, and then there's other bits and pieces that needs to be considered. So if you downgrade your property or move house, sell up, etc., what happens next, and all those kind of things you need to get advice around, so you know what you're doing, essentially. So I really wanted to kind of put that out there for people who are heard about inheritance tax, or why is, how do you calculate it? That's the start, and knowing what's potentially available to you, so you can get the right advice to start planning around it. So as I said before, you've got scenarios, assets that can really make a big dent in your wealth. And as far as we're concerned, the people that we help, they pay enough taxes during their lifetime. Surely, to have to be paying a whopping 40% in a death event, when you're trying to transfer wealth to your loved ones as efficiently and as strategically as possible, then making decisions sooner rather than later is absolutely imperative. And it's horrible when you think about especially if you're a high rate taxpayer now, you're paying in excess of 45% tax on your income, VAT. If you're a business owner, corporation tax. Maybe that's not you, but it's still tax on something that you own. Then you've got other forms of taxation, stamp duty, etc., etc., etc. Before you realize it, you're paying a lot of tax during your lifetime. So why not be able to reduce or even completely nullify the amount of tax you pay on death, and make sure that the wealth that's been transferred is 100% going to whoever you want to benefit from, rather than 60% of it going to, and maybe not in the right um, form that you had planned. So if you had a home or a house and or property in general, and you wanted to transfer it to your loved ones, but they've had to sell it in order to realize payment for the tax, then they're not enjoying the house anymore, right? So it's all these things that need to be taken into consideration. Now, one thing I mentioned earlier, which I think is important, is debt in your estate with regards to inheritance tax. So on the one hand, it's great because it can reduce the amount of your estate value. But when it comes to probate, I think it was 2013 when the Finance Act made amendments, uh, that debt would have to be cleared, or paid off, or an arrangement being paid or made, sorry, in order for probate to be granted. So what's probate? Well, in the Latin, probate in the Latin means to prove, and it's a government ministry where every individual, needs to have their estate proven or established. So if it's a tax to pay, then it's paid, or an arrangement's made. If there's no tax to pay, it's fine. You would have a will, and you would have executors who's in charge of administrating your affairs upon a death event. If there's no will in place, then a personal representative would have to hold up their hand and say they want to go ahead. So it could be spouse, it could be children, family and loved ones. There's a kind of a pecking order. So it's really important that you choose who you want to do the work first and foremost, and who's able to do it and get it done quickly. Um, but then probate, when it's granted, you got the certificate, just like a marriage certificate or a death certificate. You got a grant of probate, which is a legal um, sanction, shall I say, a legal opportunity that allows wealth to be transferred to your loved ones, to the beneficiaries. Now you're hoping that it's going to be transferred in the form, in the guise that you had imagined, i.e., the house that I mentioned, or the full amount of cash that you had imagined. But especially when debt's involved, it must be paid off first, like a mortgage, for example. Inheritance tax is due either you make an arrangement, and even then 10% is due immediately before you spread it over 10 years. And that's only if you've got large assets like property, where that might be allowed to be arranged. And so we've got to look at an exercise to mitigate risk. And so one of those exercises, which is, I think, is the most simplest way to deal with it, is life insurance. Um, and most people have life insurance policies, but the question is it the right type? And is it maintained correctly? So, I.e., is it in trust? Number one. And if it is in trust, then if it's in trust, that's fantastic. So it's not part of your estate. But is it doing what it's supposed to do? I pay off the mortgage, etc., etc. So that's the simplest way. But the later you leave something like that, you get older, because it's based on risk. Generally speaking, um, it's more expensive the older you get. No one knows when you're going to pass away. Most life insurance policies are we call term assurance, so they will expire at a period of time. Maybe the longest one, maybe 92, and people may outlive that, and they still have debts at that point, or potential inheritance tax liability at that point. Then how are you going to mitigate it if there's no substantial savings? So something called the whole of life policies or life assurance, maybe something to consider sooner rather than later. Um, you hear stories, I'm not going to go into too much detail of how the wealthy use life insurance to really produce wealth significantly. Um, it's big in the States. It's still a big, I think it's a big deal over here or certain communities to take out life insurance policies or life assurance policies. Family members will contribute towards the payments because they're going to benefit from it. And ultimately, with that said, if it's in trust, you can pass it down from generation to generation. And we'll talk about more in a separate show or separate session. But ultimately, it's a very simple way, effectively a simple way. Especially if you do it early and get the right advice around that, speak to the right um, qualified professional to do that, well, especially if you spoke to someone like myself or a professional in my industry who shows you the end game and what it could look like at a particular point in time for you, and then what you could do to mitigate that. The sooner you do it, the better it is for you, and then review it every, you know, 3 years or a major change in family situation or circumstances. So something like that is really important when it comes to probate and mitigating um, delays, ensuring that the wealth is transferred smoothly, um, and also quickly, because if assets are held in the deficit state for too long, and we're in a bubble where property prices are racing up and up and up, capital gains tax could potentially be a problem when the property is due to be assented or transferred to beneficiaries. Having a switched on probate advisor to know how to do that to minimize as much capital gains tax as possible. It's not that hard now to pay capital gains tax. The allowance is only £3,000. So before you had a bit more of a wiggle room. So it's important to look at things like that. Okay, so um, uh, long and short of what I'm saying, I don't want to go too technical, is really look to plan ahead as much as possible. Don't think, oh well, I'm not there yet. I shouldn't be concerned about wealth and concerned about death, should I say, and transferring it. Oh, got plenty of time to worry about that. That may be the case, but if you are really concerned about generational wealth or don't know what it is and you want to start inquiring, but you want to pass wealth down to your loved ones and family members who you're working hard for that purpose, then inheritance tax is one way that wealth can definitely be. I think stolen's the wrong word to use, but it can definitely erode your wealth quite dramatically if planning's not done in the right way and the right advice is not really being provided. Okay, so just a few things to think about, to ponder, to chew on. And again, if you're in a whatever wealth bracket you may be in, if you're super affluent um, or due to receive a massive inheritance, then it's wherever you are, whatever stage or journey you are in your personal walk. Uh, Plan ahead. Know step 10 before you start step one. That's step one. That's kind of my philosophy. Um, it's important that you get as much information as possible. Now you can surf the internet as much as you like, but sometimes analysis paralysis and confusion and overwhelm is not necessary. Where just getting the right guidance. Sometimes you just don't know what you don't know, and that's even more dangerous if you don't know what you don't know. Um, will help you to make an informed choice to protect your loved ones as much as possible. So I think I've exhausted that topic for now. But if you've got any questions, feel free to drop it in the comments, whether you're watching this live on YouTube, watching it live, or particularly if you're too late on the replay on LinkedIn, Facebook. Drop a comment and we'll come back to you, or just send us an email. You can see on our screen our link tree. That's all of our available links are there. All of our resources are available there. So if you want to check out any previous trainings, not just our podcast, but other resources that we have available to you, feel free to check that out. Check that out as well. All right. But other than that, I think I'm going to leave it there. And we'll probably have a break now since we've reached episode 10. We'll start season 2. But again, thank you so much for your kind words, for all the feedback we've been receiving. It's been really amazing. Enjoy the rest of your evening, wherever you are around the world. And thank you very much. Speak to you soon. Cheers.